Welcome to another exciting exercise. This one is going to be on recording and assessing the effects of installment loans. So, we go out and we borrow some money and we have to record that. But additionally, at some point, initially when we do this, we're going to find that we increase assets and we also are going to increase liabilities. But then as we move on, we actually have some income statement effects as well. So let's get to it. It says on December the 31st, Denning borrowed $500,000 on an 8% 10-year mortgage note payable. And it says the note is to be repaid in equal quarterly, very important, installments of $18,278 beginning on March 31st. So what they want us to do in here is they're going to have us do some journal entries, and then they're going to ask us to do some T accounts, and then down at the bottom, right down here, is where we're going to kind of get into how this impacts both the income statement and balance sheet, look at it a little bit more in depth. Okay, so we borrowed the money, it's important to note, on the very last day of the year. So what happens? Well, the only thing that's going to happen is we're going to increase an asset, all right, and then we are going to also increase a liability. Now, I do want to note, you see these little arrows here, this is some kind of an online exercise. And so they may want something other than note payable. They may want mortgage note payable, something like that. But all we have to do is just record this $500,000. This is a regular interest-bearing note. If it was a discounted note, we would do this a little bit differently, so do be advised. But this is a normal interest-bearing note. Okay. So that's it for, that's it for December the 31st. Then we get 3 months into the future. And they've kind of given us a hint here that we're going to have some interest expense. All right. And so interest expense is what's going to go up. But we're also going to have two credits here. Okay. And one of those will be to reduce the amount of the note payable, and the other one is going to be cash. Now, cash is the easiest one because they give us the amount of cash that's going out, $18,278. So we can go ahead and record that right now. Make that 7 a little bit better. $18,278. But how much of that is allocated to interest expense, and how much of that is allocated to note payable? We're going to split this up into two pieces. Again, part for interest expense and part for note payable. So what we want to recognize here is that we're going to be paying 8% on $500,000 on an annual basis. What we can do is we can go ahead and take this 500,000 and we can multiply it by 8%, and we can get the annual amount of interest that we're going to be paying. However, we're making quarterly installments, or once every 3 months, so we're going to be doing this 4 times in a year. So we can divide by 4 and come up with $10,000. Now this is one of the ways that we can do this to get our interest expense here. The other thing that we could have done, since we know that we're making 4 of these payments, is we could have taken this 500,000 and, well, let me back up. We could take 8% and divide by 4, and that's going to give us 2%, and then we could multiply that by 500,000. Kind of just depends on how you want to do it, okay? But this is going to be our first interest expense amount, okay? So $10,000, and then the difference between $10,000 and $18,278 is the reduction to notes payable. Okay, and that's all we have to do there. And most students, again, I've said this before, do pretty well here and here. It's this third one that sometimes causes some issues. Okay, so you know, if it were me, I would think of this interest rate as being 2%. I would think of it as that second way that we did it, 0.08 divided by 4 is 2%. Okay, so what we have to do here then, with that in mind, is we have to adjust our carrying amount of the note payable. Originally, our carrying amount was the amount that we borrowed on an interest-bearing note of $500,000. But now we need to reduce that by the reduction to the note payable that we had on March the 31st. So I'm going to subtract 8278. So that's my carrying amount, and then I'm going to multiply that amount by 2%. Okay, and that's going to give me 9834. We'll say that's we're going to round down 9834. Okay. We're also going to have a debit to the note payable itself, and we're also going to have a credit to cash. And you know, while I'm at it, well, let's just say this. I'm being a little sloppy here. We need to kind of move this over a bit, move this over a bit, and move this over a bit. So let's see here now. We paid out $18,278, and let's back up here. $18,278, and so we can go ahead and record that as our credit to cash. All right, and then we're going to subtract this interest expense amount from that. Okay, 8444. Okay, and that's all we have to do. We don't have to go any further with it than that. All right. Okay, so let's go ahead and move this out of the way for just a moment. By the way, if we did want to go further, then we would be you know, our next step, and I'm just telling you this just in case you have an example like this. Let's see, what was it? Gosh, I can't remember now, so we'll just have to subtract both of these. But if we had to go one more period, right, we would have taken this reduction here. Okay, and that would give us this amount here. And then for the next period, our carrying amount would be this minus the reduction to note payable. Okay, so as we go, we're incurring some interest expense, but we're also reducing the amount of debt that we owe. Okay, do make sure that you understand that, you know, note payables, we reduce the debt and interest at the same time. With a bond, all we do is make interest payments, and then we extinguish the bond at the end of its life if we don't do so beforehand. Okay, all right, so let me kind of get rid of this here, and then we can go down and do our T accounts. Kind of adjust this here. We can do our T accounts with the information that we already have. Okay, so let's see here. They haven't given us, we've got 3 transactions involving cash. So what we're going to do is we're going to do it like this. And again, now I see there's a different color shading here. I'm not sure if that's for cents or what that is. It's set up earlier to round to the nearest whole dollar, so not exactly sure what we're talking about. I think what I'm going to do is I'm going to put a date here, and then I'm going to put $500,000. That's what we did right here. And then I can go, and for cash I can say 331 and 630, and we had two reductions that were the same. Okay, so the cash is down in these two transactions, and it goes down with a credit or over on the right. That's how assets go down. All right, so mortgage note payable. Let's see, we're going to do this one a little bit differently. Note payables go up with a credit and down with a debit. So we've got 500,000 there. And again, I have no idea if they're wanting me to put the dates in here or not. So we would just go up here and we would look at the amount that we reduced the debt by. 8278 on March the 31st and 8444 on June the 30th. And then our interest expense is a little bit easier. Interest expense, as all expenses, go up with a debit. So we don't have anything for the beginning. We just have to deal with the end of March and June. And so we can just come up here and grab our two amounts, $10,000 and, let's see here, what was it? $98.34. Okay. With expenses, we would rarely have anything over here unless we made some kind of a mistake. All right. So then for Part C, it says record each of the transactions from Part B in the financial statement. Effects template. Use negative signs with your answers when appropriate. So if the result is that an account goes down, or if net income goes down, we would use a negative. All right, so let's just start with the first transaction. We have and this is, I'm going to have to kind of squeeze this in here. It was hard to get the screenshot in. But we have an addition to the cash asset, $500,000. And we also have some liabilities that have gone up by $500,000. So these would both be positive numbers because both went up. Okay. Payment on the note. This is where we're going to use, and I'm going to use a parentheses because I think it will show up a little bit better than just a negative sign. So $18,278 is the amount of my payment. My liabilities are also going to go down, and they're going to go down by this amount right here for the March the 31st transaction. So what is that? 8278. 8278. Okay. All right, and so sorry, my video quit working. So the part that you didn't see was earned capital went down by $10,000. Let's see, let's move this out of the way so we can see this. By the amount of the interest expense, expenses went up by $10,000 and net income goes down by $10,000. So if we wanted to think about this as far as how this would flow, expenses have gone up by $10,000, therefore net income is $10,000 lower, and then net income flows from the income statement into retained earnings on the balance sheet. All right. We also have here, I think the video cut this off as well. 630, we have a payment of $18,278. That's going to be the same. So the cash asset is going down, And then we also have a reduction to our note payable for the 84.44. And then we can come over here and get our interest expense, and we're going to do the exact same thing that we did before. Reduction to earned capital, expenses gone up, and then net income is down. So again, expenses up, net income down, and then that flows over into retained earnings on the balance sheet. Okay, so we got to look at, let me move this out of the way real quick. We got to look at it from a journal entry perspective, and this is where we kind of did all of our math as far as coming up with the amount of each payment that was allocated to interest and to principal on the note payable. And then after that, it was just kind of filling in some spaces. We also, again, just as a recap, said, I'm kind of making this up as I go as far as putting these dates here. This is really not how it would be normally. Most of the time, they want you to put these figures on different rows. So we would need 3 rows here and 3 rows here. So I'm not exactly sure if you were doing this in a homework assignment again. I know that the numbers are right. I just don't know if their layout is exactly the way I did is what they have in mind. And then we finally, we just did this, the financial statements effect template. All right. Hope you learned something. Thank you for watching.